Market trends showed a mix of gains and losses influenced by varied economic indicators and central bank decisions. Meanwhile, oil prices continued their decline amid expectations of sustained high US interest rates as Wall Street closed in positive territory, reflecting investor optimism. Asia-Pacific markets showed varied results on Wednesday, with Australia's S&P 200 gaining 0.12%, Japan's Nikkei declining by nearly 1%, and South Korea's Kospi slightly rising. New Zealand's main index climbed 0.5% following the Reserve Bank's decision to maintain the official cash rate at 5.5% for the 7th consecutive time, reflecting economic stability. Oil prices dropped for the 3rd consecutive session on Wednesday due to expectations that the US Federal Reserve may keep interest rates higher for longer to combat sustained inflation, with Brent crude futures falling to $82.45 per barrel and US WTI slipping to $78.16. The S&P 500 rose by 0.3%, while the Dow Jones and the Nasdaq composite gained 0.2%. Russell 2000 index of smaller companies fell slightly by 0.2%. Let's get more on this now with Josh Mahoney in London. He's Chief Market Analyst at Scope Markets. Thanks for joining us, Josh. We've seen oil prices decline for 3 consecutive sessions now. What's the reason behind it?
Yeah, first and foremost, it's worth stating the fact that May essentially has seen WTI trading within a $3 range, 77 generally around the lows and $80 around the highs. We're now falling back down towards that $77. But it is true that we have seen selling for energy markets, most notably last month, and we're seeing that sentiment really echoed in recent trade. Part of that comes down to inflation expectations. We have seen relatively lofty, certainly monthly inflation figures, and we've seen it once again for the UK this morning. 2.3 on the headline number. That sounds great, but we saw the core number coming in at 3.9 with a monthly reading of 0.9. Both very problematic. So inflation, whilst we're expecting to see it collapse, hasn't necessarily happened to the extent that we're expecting. And so Europe, alongside the US, I think are likely to see a resurgence in inflation in the coming months. Of course, elsewhere, we're looking at, say, Middle East concerns. Well, they do continue to rumble on when it comes to Israel and Gaza. But at the same time, we haven't necessarily seen interruption in terms of oil supplies. That Iran-Israel sort of headbutting that we had seen not so long ago seems to have died down. And so certainly from a geopolitical perspective, things have eased.
Right, Josh. Now, how might sustained high US interest rates affect global oil demand?
Well, ultimately, interest rates are a tool utilized by central banks to drive economic growth and economic activity. If they raise interest rates, then they're trying to stifle activity with a view to driving down inflation. So, we know that they are trying to cool market growth or cool economic growth just to drive down those CPI numbers. And with the fact that they have remained relatively high, it means we're going to have to see interest rates remain higher for longer. It means that economic activity remains depressed, and therefore demand for energy products and most notably the likes of crude oil, the likes of gasoline, is likely to remain subdued for the time being. That supply-demand dynamic therefore shifts and it weakens the price of WTI as we're seeing today and over the course of this week thus far.
Right, now on the equity front, we're seeing mixed performances over in Asia-Pacific markets. What's behind that?
Yeah, it has been a relatively mixed session. I mean, one of the notable events that happened overnight was the RBNZ interest rate decision. And despite the fact that they pushed back those interest rate cuts, which should be negative for equities, we actually saw the New Zealand market outperforming many within the region. We saw the ASX doing relatively well, once again gaining off the back of the likes of the mining sector, the likes of financials. But in the end, we saw some of the communication names, the retail names, driving that index back down towards parity. And alongside that, we saw the Nikkei 225. That was perhaps the biggest mover of the session, down 0.85% off the back of the latest trade data that saw exports growth growing by a smaller figure than expected, came in at 8.3% versus 11.1 expected. But bear in mind, we may be down almost 1% today. But if you look over the past 6 months, we saw a 15% gain for the Nikkei 225. So really, this appears to be some profit taking, particularly in the tech sector ahead of Nvidia earnings.